Hello, and welcome to Bridgeford Trust Company's Delivering Direction and Control podcast series. Our podcast series is designed to educate, challenge, and inspire listeners while keeping you updated on developments regarding modern trust law and powerful planning opportunities available, all in an effort to deliver direction and control to clients and their advisors.
Hello, everybody. This is David Warren, co-founder of Bridgeford Trust Company and chair of our board, here with another installment of our podcast series, which, as I've been saying recently, surprises me with just how popular it has become. We're humbled by the quality of thought leaders from across the country and really around the world that have taken the time to talk with me about big ideas and how best to serve high net worth families. And I think that's the common theme that is developed, is the ability to find big idea solutions and to be of use to the families that we serve. And today is another example of some tremendous thought leaders that have been doing this kind of work for many, many years with tremendous credentials. And before I introduce them, I want to mention that they have recently joined Callan Family Office, and that may sound familiar to our listeners because we had the amazing good fortune to have the founders of Callan be on our podcast program. If you haven't seen it, I encourage you to see it. It's a remarkable story of how some entrepreneurial-minded thinkers from a big bank broke apart and created an independent solution serving high net worth families. And the growth trajectory has been amazing. Their position in the marketplace is incredible. They haven't been around, I guess, not even 3 years yet. And they have developed a brand for various reasons that is really amazing. And we've had, great fortune to have been able to collaborate on serving some families together. The leader there, Jack, is very much an innovator and a dynamic person. So again, if you haven't heard the podcast and you want to know more about them, in addition to what you're going to hear Jeff and my friends today talk about, and Lisa, please go to that. But let's get to Jeff and Lisa. So as I mentioned, they are both highly credentialed, very nice people, most importantly. But have been serving high net worth families for many, many years. And what's so exciting about their trajectory, as they will tell you, is they decided about 6 months ago to join the speeding train that is Callan and develop a whole new exciting business line for them. And so I love the entrepreneurial spirit and the vision for what Jeff and Lisa brought to Callan. And I think it's such a natural extension to the great work they're already doing for families. And so with that, Jeff and Lisa, thank you for joining us.
Thanks for having us, David.
Yeah, thanks for having us.
Of course. So Lisa, why don't I start with you? Tell us a little bit about your background, if you don't mind, how you met Jeff, and I think it's very important, I think, to set the stage because we want to position you both as the thought leaders that you are. So let's tell me about how you jumped into this in the first place.
Yeah, so Jeff and I go way back. We've been working together for the last 14 years. We met at the regional bank where we were both previously with before we joined Callan, and built a national business advisory practice together with the team. And it was a fantastic experience. My background is as basically a wealth strategist and a wealth advisor. I've spent my entire career, the last 2 decades, working with ultra high net worth clients, and almost all of them exclusively business owners that were preparing for a liquidity event. So it was great to team up with Jeff. I recognized we laughed with each other because I recognized his value pretty early on. I was an early adopter when he joined Key, and we were thrilled to partner together in working with our clients.
That's great. Well, Jeff, it's great to have you on as well. You have an impressive background in addition to Lisa's, and I also know you were a prolific writer, and it seems that you and I have written about, I think, some of the same topics over the years, just didn't realize it. Of course, you wrote about them better than I did, I noticed, but I don't admit that very easily. No, but all joking aside, I know you've been a thought leader looking at the same issues that we have at Bridgeford for a long time. The value of proper jurisdiction selection, asset protection, the kinds of things that we can do that didn't exist when you and I were in law school, quite frankly. Lots of the things we talk about today, Jeff, right, weren't even available. Directed trusts were not available nobody when they were when we were in law school. But no, Jeff, tell us about your background because, again, you both are so impressive, and I think it's important that people understand just how much experience you have.
Yeah. So my background is I'm a tax attorney, M&A advisor, and like you said, I've been an author in a number of books and articles over the years. My most recent book is The Descent is the Real Climb, which is geared towards for business owners about how to successfully navigate the business transition and transaction process, which does walk through a fair amount on the transaction side, particularly the tax issues that come up for business owners in a transaction, and does leverage a great deal of my background in the trust space, because a lot of the work that we do does involve trust and what I call the super trust jurisdictions. So places like South Dakota, Delaware, Nevada. Historically, I was raised on the Delaware trust business because I did come up, so to speak, in the East Coast. But over the past few years, I've become very familiar with South Dakota trust law, become a big proponent of it. And hence, one of the reasons we're super excited to be on this podcast and get really connected with you and your company, because we love the laws of South Dakota and really looking forward to spending more time with you and doing more business with you.
Oh, I appreciate that. Yeah, and you tap on something that we're so passionate about. I mean, whether it's Nevada, South Dakota, Delaware is still good. I mean, the reality is there just are better jurisdictions out there. And I'm still amazed, quite honestly, especially out here in California, how few planners know that or think about it or consider it. I mean, I don't, not to become preachy, but it's become a bit of a prophet about, hey, what are you doing in California? When you're about to sell your business, that's almost malpractice. You need to get out of California kind of a conversation, which lawyers don't like it when you throw that word out. So I'm not always received well. Well, talk to me about Callan, because I mean, obviously, I mentioned it's they're on a super trajectory, but how did you find them, and what is it about them that made you decide to take your impressive practice and drop it into we'll call it a rocket ship, drop it into the rocket ship? Like, what was the thought process?
Well, it definitely is a rocket ship. We've only been here for the last going on 6 months, but it has been fast and furious, and we're just excited to build our practice there. I think what was really unique and attracted us to Callan was their entrepreneurial spirit, right? The fact that we've been working, Jeff and I have always said, like, you get kind of, when you work with business owners over and over again, you start to realize that there's a really unique quality that they bring to the table, and our ability to kind of connect with them and, work with Callan it was a game changer for us, right? I think the fact that they're independent, that was a big thing. We kind of have very similar histories. In the fact that they, where they came from, leaving a big bank, we were at a regional bank, and we just wanted a different path for our practice, right? And it was exciting to be there and be part of it. They're very, very much innovators. The way they look at technology is really exciting. So they saw our practice as a real organic growth driver, which is really exciting.
Yeah, I like the way you say that. I mean, in fact, all three of our firms, well, now two, but the three of us, if you keep yourself separate for a minute, that's what's a huge driving principle is the independence. It's something that where Jack and I and others really connected on, because that's another problem in our industry. I was a banker in Mellon for years, had a great experience before that, practice law, and I was amazed at how much, I still am amazed at how much conflict of interest there is. Your model, our model, removes all of that. And I think that's something that needs to be celebrated and talked about more. And Jeff, from your perspective, what was it that attracted you? I mean, I would imagine what I noticed is they'd have a tremendous technical acumen, which I'm sure you appreciate. So tell me about that and like what was going through your mind.
It's certainly the ability to start brand new from technology, because a lot of the bank legacy systems were so much bolt on, and having to keep old legacy systems and keep fixing things to try to make things work that have been around since the past. But I really think, from my perspective, and I'll speak for Lisa about this one, when you work in the transaction space and you deal with business owners, you see how entrepreneurs have built something from the ground up. And it's interesting that we spend so much time advising these owners on that second half of the business life cycle, the exit strategies, or how to offboard those businesses. And we really felt that if we were going to take this practice somewhere, we really believed and felt that it was time for us to do it ourselves and to build that practice somewhere where we were entrepreneurs ourselves. So we had talked to a bunch of different institutions before we decided to leave our prior employer. And Callan Family Office was definitely the one that had the best entrepreneurial spirit and the best entrepreneurial outcome, we believe. And so that made an easy decision when we started really talking to them and really dug into what they were up to from a technology standpoint, from a philosophical standpoint, and just from a cultural standpoint. We really felt this was the right place. And 6 months in, I can state with absolute certainty, no regrets. We are super thrilled to be here, really believe in what they're doing. And our practice, although it's very different than anything else the firm had done up to this point, it has just synced in so well. They're super supportive, and it's just been a wonderful experience almost since day one. So
That's great.
it's
That's
double
great.
thumbs up. Great choice.
So we'll come back to Callan in a minute. What I want to make sure we do, though, is let's define your practice. So we've talked about it in big picture, and it's innovative and exciting. But let's get into some of the details and maybe some of the statistics that we've talked about and you've shared with me that are driving your business, quite frankly, your business model, and why it is what you do is so important now, maybe almost more than ever, as so many of these businesses are transitioning. So maybe, Lisa, why don't you touch on that? And because I want to hear from each of you, your perspective of what it is you've built over the years, because I'm sure you may look at it a little differently. But Lisa, go ahead.
Yeah, so we really saw the opportunity. Obviously, the statistics are, compelling, right? As a growth driver, right? We hear that 75% of business owners would like to exit their business within the next 10 years. If you think about that, that's about 4.5 million of privately held businesses that are going to transact, and it's about 14 trillion in assets. So, when we look at the opportunity, right, for a Callan and for us in working with business owner clients, it's tremendous. And, if you look at that and even break it down further, 50 baby boomers represent 51% of privately held businesses. So that's amazing, right? And the ability for us to work with those owners and get in early. I think the thing that is unique about our practice and really makes it stand out is our ability to meet owners where they are in their company life cycle. So our ability to look at an owner that has perhaps all of their assets, all their net worth tied up in their business, which is a common scenario, right? Most of the owners that we meet with may not, especially if it's their first transaction, their first business, have a lot of liquidity on the outside. So our ability to meet them where they are and see the value of the business as the opportunity and get involved with them 3-5 years before the transaction, right? So we have this really long runway where we're getting to know them, helping them and meeting their needs where they are. And then, when the transaction happens and preparing them for that transaction and get a really great tax outcome. I mean, that's ultimately the goal. And our ability to kind of capture the assets and do it in a unique way by adding value throughout their life cycle, I think is pretty unique in our industry. I don't think a lot of people have that kind of patience where they're and to have the luxury of being able to do that at a firm like Callan, I think
So
is
if I can comment on that, what's interesting, and I remember this from my days at the big bank, we'll call it.
yeah.
The asset managers were chasing the liquidity event, right? And they wanted to get the money to manage, but nobody was really focusing on preparing, as you say, 3 to 5 years in advance. And I still see that and we don't manage money at Bridgeford, so that's not our model. But I see where asset managers come out of the woodwork when suddenly there's rumor that they're going to sell. And I said, well, where are the people 3 years in advance planning? So Jeff, that's probably a big passion point for you, right? I mean, you being able to get in there with your expertise, not 20 minutes before they sell the company and help them has got to be very satisfying. So talk to me about that.
Yeah, I mean, you hit the nail on the head, David. I mean, at the end of the day, I like to tell people the tax toolkit, so to speak, when you're in transaction tax planning, is very wide. If we have 2, 3, 4, 5 years in advance of a transaction, there's almost an unlimited supply of strategies that we can deploy. If we get to 6 months, 6 weeks, 6 days, 6 hours before the transaction, it gets very, very narrow. There's very few things we can actually do. So we really get excited when we have the opportunity to dig into a situation 2, 3, 4, 5 years before a transaction actually occurs. Because when you think about it, with that much time, we're only limited by our ability, our creativity, and the client's willingness to allow us to spend the time with them to understand deep down what they want to achieve and what would be best for all their stakeholders. If we don't have that time, if it's 6 days or 6 hours before a transaction will actually occur, the toolkit gets very, very narrow, very small, what we can actually achieve in a transaction. So when we sit down with owners, we typically tell them, when you really parcel things out, the average tax rate across all transactions across the United States, because you have to include in the state income tax impact, local income tax impact plus federal is probably around 30%. So about, let's say, a third of the purchase price or the sale price is going to go to taxes. So say 30, 33%. It's really not that difficult if we have just even a little bit of time to work with an owner to whittle that number down to 20, 18, 16, 15, sometimes even 12 or 10% or even less if the client's willing to dig in with us. So it's an interesting challenge. It's kind of like solving a puzzle for a lot of these clients. And that is something we really enjoy doing, which sounds a little strange, but our clients give us that leeway. And it's a great opportunity for us, and it's something we really enjoy doing for them and it's something we really appreciate them giving us that ability to dig in and trust us to give them the largest financial asset they own and give them that optimized outcome, which is what we really strive for. And by the way, some of those clients will show them all these wonderful things we can do, and they just come back with, we just wanted to see what was out there, and we're going to do almost none of the things you recommend. And that's okay. They just want to make sure they fully vetted everything out. So that's really the name of the game here. So that's like a tax lawyer's dream, to be able to dig through these things and have a big runway to exhaust all
Well,
those
yeah, I
ideas.
agree completely, Jeff. And so many times, we get the call, and of course, at Bridgeford, we're not giving legal or tax advice, but because of all the writing and stuff that we do, we get a lot of questions. And some of the most disappointing questions I get is, "I just sold my business. What would you recommend?" Or "I just signed the, purchase and sale agreement," whatever. And as you say, so much gets cut off, and in terms of the runway, where you have the ability to save money. And this isn't, and I always make this point on podcasts and really everywhere I ever go is, we're not talking about, tax evasion here. We're talking about tax planning, following all the rules. And I've recently, been using this analogy. Those who know the rules of the chess the best usually win. And this is what this is just a chess game, right? I mean, it's really what this is. And I get a little defensive of our industry because I've been sort of cornered with, well, you're nefarious because you're helping rich people evade taxes. And I'm like, that's not at all what we're doing. And I'd like you both to comment on that, because I think our industry has been kind of under fire a bit, because of some data leaks and whatever. So Lisa, how do you feel about that? Have you confronted that? And because I think what we're doing is noble, and I don't think we should be embarrassed about anything, because we're doing great work for great families that deserve to be given opportunities to plan. But Lisa, where do you fall on that?
Yeah. I mean, I think anything, looking at all the options, right? I think working with their tax and legal professionals, we feel like we have a unique insight, just based on our background, right? As an M&A advisor, as a tax attorney, the ability to kind of bring all this together for them. I think that there's a value sitting there. And listen, we're not the ones that are going to sign their tax return. They have a tax preparer that does that, and we're always making all of our recommendations in conjunction with their other professionals. So we find it's a very collaborative experience when we're working with them and talking through. Listen, these are some of the options we think you could consider, and kind of meeting the clients where they are with what their comfort and what their appetite is.
Yep. Jeff, your thoughts on that?
I was just going to say that, we don't write the rules inside the Internal Revenue Code. At the end of the day, the Internal Revenue Code, to a large extent, and I have to thank my Pitt Law professor, Bill Brown, who taught tax law when I took it as a second year, for this thought process, that the Internal Revenue Code really is a looking glass into our philosophy as a society to some extent, is to encouraging or discouraging certain behaviors, that the laws that exist for tax policy sit inside the Internal Revenue Code. So we give deductions for charitable giving. We provide exemptions and benefits for giving money to surviving spouses. We give exemption and benefits to giving money to children or to grandchildren. Now, we also give limitations on those, because we don't want to allow people to give away too much in certain categories. So all we are doing is we are looking at those rules, those guidelines, which are a looking glass into our society, that say we want to allow individuals to benefit these certain things because we believe there's a societal good. And we're taking those rules as defined in the Internal Revenue Code, and we're finding ways to enhance them to their highest value. So we're not doing anything wrong. We're just showing people how to use them most effectively.
Yeah,
And
it's
if we
perfectly
push
said.
things too far, which at times is a um, profession we do, then that's where the IRS has the ability to pull us back, whether it's through the tax court or ultimately going to Congress and changing the rules, so to speak. So I don't want to say it's a cat and mouse game because it's not. It's just looking through the ability to to push these rules, keep things within. Nobody's going to jail. We want to keep things within the certain guidelines. And then if we go too far as as a group, then we get pulled back. So, I don't think we're doing anything wrong. I think we're actually doing something that ultimately has some level of societal good. That's the way I view it. And I think it's worthwhile. It's a worthwhile endeavor. And, our clients appreciate us for doing that. And at the end of the day, a lot of the work we do does provide significant benefits for pieces and parts of our society. I can tell you that it's very rare in most of our larger transactions. For example, there's not a significant charitable component to it for clients who otherwise probably don't or wouldn't typically consider charitable giving. And they do now because they see the tax benefits. So that is a societal good. And we feel pretty good about that because that's something that otherwise wouldn't come to pass.
Now, that is really well said. I never thought of it from that perspective in terms of, the tax code is a reflection of the values, and all we're doing is following the rules. So not only is it not nefarious, but it's, like I said earlier, somewhat virtuous. I mean, we're just doing the best we can with the rules given to us, right, to help our families. And there's nothing wrong with that. One of the things I wanted to touch on, because we have focused so much on the tax planning, and I love how you approach this as a tax trilogy, and I've never thought about it like that either, because I look at it, but I never defined it that way. The sort of three areas. So I want you both to comment on tax trilogy. Then I want to move away from taxes for a minute, but explain that to our audience, because it's a clever way of saying there's three distinct areas you can look at and plan for. But I've never heard it said like that. So Lisa, what does the tax trilogy mean to you?
Yeah. Well, we spent a lot of time trying to find a way to capture what we were doing for clients, and it really was looking at kind of the three phases of a transaction: pre, during, and post. And how do we work to eliminate kind of and help defer or reduce federal, state, and transfer taxes? So it was a way of kind of capturing it. If you look at our materials, we kind of have it as a triangle pyramid there, and our ability to kind of look. And again, it speaks to meeting clients and business owners where they are, right, in their company life cycle, and to be able to deliver a really good result.
So I have to look at your materials again. If they're not copyrighted, I'm going to start to use that. Is that okay?
I know. I told them we should have copied the tax trilogy. I mean, we had a lot of back and forth on what do we, and the visual.
Just don't be concerned if you see some interesting things on our website. I'm just joking. But I always am excited about finding clever ways to say something. I like that a lot. And, Jeff, I'm sure you'd echo what Lisa said. I mean, but from your perspective, talk to me about that. I mean, it's because I want to get into what you see as common problems, but often I see one of the three components of the trilogy missed or not even talked about. And typically it's the state tax play that I see missed a lot. So talk to me about that.
Yeah, so you're right. It is the one that's most often missed because in a lot of jurisdictions, it's the smallest percentage or the smallest number, but it's the one I think in a lot of cases is the most easily addressed, right? And I'll pick on the lawyers for a second because I am one. It's one that we're not typically taught in law school. We're taught to focus on the federal, right? Because federal is, national, right? It's something that we're all taught. It's easy to teach across all 50 states. But when you think about it, there is the state government sitting out there, and the states, by the way, that every state but one has to have a balanced budget. So states are always on the hunt for revenue. So they tend to be relatively aggressive about getting paid. But there are also a lot of their statutes are written that are relatively easy to get around the state income taxation statutes. Not all, some, or a lot of them are. So it's relatively straightforward in a lot of cases to do state income tax planning, to structure deals in such a manner, we're talking about transaction planning right now, in a manner that we can defer, reduce, and then sometimes even completely eliminate state income taxes through the use of, and we're kind of beating around the bush here, through the use of moving assets across state lines, utilizing
Getting them out of the state.
trust.
Well, and we even have case law now at the federal level, well, also at the state level, that supports this. I mean, this Kastner case, maybe you want to touch on that. I mean, of course, Bridgeford was in existence long before that, but we, among some of the thought leader attorneys, believed, just as you said, it's as simple as getting a trust out of California, out of New Jersey, into a no state income tax. And we took the position that these states were not allowed to tax undistributed income. And we were aggressive about it. And then, as you know, these states started to, at the appellate level, agree and say it was constitutional. And then all of a sudden, Kastner comes out of the Supreme Court. And to me, while it's a little narrow, was kind of a home run for everything that we've been talking about. And I think a lot of lawyers still don't even understand the implication of that. I love you both to comment on that.
It's always surprising to me when I run into situations where this is a big surprise to outside counsel, that they really don't understand the state income tax issue. Kastner should be widely applied. You can't utilize it in every jurisdiction. There are some states that have effectively shut down a lot of the planning opportunities in this particular context, but the majority have not. So there's still a fair amount of opportunity in a great deal of jurisdictions. And it's always worth taking a look at, right? I'm never one to say that something always works. And I'm also one to say that something never works. Those two words, always and never, is something I always stay away from in tax law, right? When someone says always or never, my hair goes up, the radar goes up pretty quickly, because that's usually wrong, either of those two extremes. There's usually a lot of gray area. So a lot of the work that we do is right smack dab in the middle of that gray area. And we just need to spend some time navigating and figuring out, is it applicable, not applicable, and how far we can take things. And a lot of that
my favorite, and I'm sorry, I didn't mean to interrupt you. Get, I'm sorry, good.
That's all right. No, it's just dialogue, right? It's just the dialogue we're having right now. Like, how do we utilize this in a way that everybody's comfortable, right? And a lot of times the final decision will be from the client. We're just going to score this. What's the likelihood of audit, and what's the likelihood of success on that audit or negotiated settlement? And that's, we could go on and on and on forever on this podcast, personal experience. I'm sure you've had some, I've had some with clients over the years of dealing with different jurisdictions, different states on this particular issue, because states, not always, but some are willing to negotiate when they dig into this, and they say, hey, we don't want to go 10 rounds about this. Are you willing to take a settlement? And because we don't want to litigate this issue. Well, if I can get a settlement from a state on 50% of the tax liability, that's a win. If I can get it for 10% of the tax liability, that's a really big win, right? Let's be realistic about what the outcome is we're getting.
Yeah. No, it's perfect. And I was going to say, I was laughing. I mean, the conversations that I've been in where a lawyer looks at me and says, that doesn't work. I'm like, okay. I don't practice law anymore. So, and I don't carry my practice insurance. So I get quiet at that point. I get angry, but I get quiet. I want to switch gears a little bit into a part of, I'm sure, of your practice that is that has to be considered is somewhat of the touchy-feely side of this stuff. And what I mean by that is, or sometimes it's referred to as the soft side. So you were getting to know a family for 3 to 5 years, ideally, before an exit. It could either be sold outright or transition to the next generation. And there's a show that I became pretty enamored of. It was the show Succession. And I bring it up a lot. And in fact, I'm thinking about writing like a white paper about showing, all the things that went wrong in a family dynamic because of poor planning, poor trust planning, and all of the things that make that show so salacious. But the point is, that's a real pop culture example of what happens when families don't talk to people like you 3 and 5 years in advance. And I guess, Lisa, I wanted you to comment on that. I mean, so there's the hard side of it, meaning the taxes and getting it in the right jurisdiction and all those important things. But there's also, and Jeff, you kind of touched on it too a little bit, but you're also probably helping these people figure out, hey, is little Johnny, does he have the acumen to take over the company, or how are these siblings going to get along if they all don't become co-CEOs or whatever, right? So talk to me about how you have those conversations, because they're almost as important as where to put the trust, right, for jurisdiction purposes. Because if you get those issues wrong, you blow up a family, right? So I mean, it's worse than paying too much in taxes, and that's where succession. That's the lesson of succession, is that family blew up because they didn't have somebody like you. It wasn't even about money. So yeah, please comment.
So I think navigating and the communication styles within a family, and just, I mean, that's a perfect example of kind of governance gone bad, right? The way that they had everything set up. But it's a huge part of our practice, and it's a huge part of Callan's practice. We have two PhD that work directly with our clients to help them navigate and help them prepare the next generation, right? You want to have those conversations, and you need to spend as much time on grooming that next generation as you are in, kind of managing the business and dealing with all the financial aspects, right? Because we see so many deals too, that even transactions that, they're looking to sell, and the transaction goes off the rails and goes sideways because of family dynamics, or even the owner. Let's just step at the owner not being prepared mentally to step away from the business, or having other issues. So it's a big part of what we do. And if you ignore that, you're really not getting to know and getting a great outcome for those families. You really have to spend the time to get to know them, their family, what works, and to be able to have really honest conversations, and have people that are trained to be able to facilitate that, and to have navigate those hard conversations within a family.
Absolutely. Yeah, when we started Bridgeford, I was really, and I still am passionate about it, and we were going to get into that, in fact, and then we kind of focused more specifically on, the trust services and that sort of thing. But I love professionals like you who are having that conversation, and I gravitate towards people who are having that conversation, and it's so vital, as the show points out. Let's get back to sort of the hard side of the planning concept. So, each of you, I'm sure, kind of have your favorite strategy, right? That you like to use in certain circumstances. So, Jeff, why don't you go first? Give me one or two of the strategies that you think in today's climate are most compelling in the right circumstances. And Lisa, I'd like to hear the same from you, because, they call it what we do. We're all still kind of practicing, right? Even though I don't practice law anymore. I mean, you have to, this is up for debate. Some people like grad, some people don't like grad. Some lawyers hate the ing, other lawyers think it's the best thing since sliced bread, which I happen to think in the right circumstances. So some of this stuff is debatable, right, Jeff? So give me one or two of the ones you like the most, and or think are the most compelling, as I say.
Wow, that's really tough, because there's a lot of things in the toolkit I like to utilize. I would say, from a pure strategy standpoint, the two I typically use the most are probably a NIMCRUT, where I control where we model out controlling the distributions. So unlike a traditional CRUT or a NIMCRUT, we utilize partnerships underneath the NIMCRUT, so we can control the distribution flow. So the client doesn't necessarily have to take distributions for a long period of time. So in essence, builds up tax deferred for a significant period of time, and then only years down the road do we start a flow of distributions out. So it becomes almost like a long-term deferral technique, somewhat akin to like a retirement vehicle. Highly effective tool. Big proponent of utilizing those if the client's on the younger side. The flip side of that transaction would be testamentary CLATs. We're a big fan of those, and even sometimes lifetime CLATs. And then, of course, huge fan of utilizing the DING strategy, which is a state income tax one. Those have just really, really, really been a game changer. And for what it's worth, I was working in this field way back in '97 when that first statute was passed in Alaska. Delaware followed suit. And my master's thesis for my master's degree in tax was on the federal transfer tax treatment of the DING strategy. So it's near and dear to my heart. I like to think I know a fair amount about it, particularly how you can get almost any tax treatment with those qualified disposition and trust statutes if you're just flexible enough. So I love those statutes. I think you can twist those in many different ways to achieve almost any outcome. So huge proponent of those. Love to utilize them. So, just something we talk about with almost every client, because they can be used in almost any context. It's almost just, what do you want to achieve? and we're going to utilize this type of trust to achieve that.
Well, and there's so many different layers of benefit. I mean, there's a tax play, it's an asset protection play. It could be if it's a dynasty trust, there's a federal tax play. I mean, it hits so many things. Yeah, I'm also passionate about that and learned about it in 2012. Bridgeford actually was the first South Dakota trust company that was involved in a PLR examining how it worked under South Dakota law, and that client is still with us. And of course, it was favorable. And so, yeah, I learned a lot about it back then. And in fact, we have some podcasts on it. And maybe that's another topic we should have you back on it to have another conversation about AIMS. But thank you for that. And Lisa, what do you? I mean, I'm sure you would agree. Is there something that wasn't mentioned that you think that you'd like to bring to the table for your clients?
I think, looking at any kind of missed opportunity, right? Like when you can meet with somebody and you just see that, you have an opportunity to add value and to really get a great tax outcome. So for us, I look at the business owners that we have, most of them have roll forward equity in the deal going forward. So our ability to get, sometimes you're getting brought in. If you think about it, 50% of transactions are kind of come out of an unsolicited offer. So sometimes you're getting brought in really late, right? And there's not a lot you can do other than maybe something charitable in the year of the sale. But we talk about and get them to focus on the roll forward piece, right? Because then you have a whole new timeline, a whole new slate, and the ability to do something really great and use some strategies with the roll forward shares, I think is pretty attractive. So you get them focused, okay, try to get the best outcome we can, in the year of the sale, with some charitable pieces, but let's focus on the roll forward and what we can do with that.
I'm just going to interject here. I'm really surprised Lisa didn't bring up her favorite, which is the QSBS.
I didn't go there. I know we're spending a lot of time on it now, but I wanted to save it. I wanted to save it for you, Jeff, because I know you're passionate about packing and stacking.
Yeah, that's probably a whole other podcast, but
it is another podcast.
Spend a lot of time on, and right. I left it open for, and she probably left it open for me. But
that'll be episode 2. How's that?
It is a missed opportunity for a lot of clients, right? When you start to see, for sure.
I agree. Well, as we get ready to kind of wind up and let you go back to your day jobs, I'd love to hear from you both. What is it that our audience should be listening to or hearing from you? Not just actual large families, but other advisors who don't focus on what you focus on. What are the 1 or 2 things that you wish that people were thinking about? I already know that the runway, Jeff, you mentioned was really important, but a couple of takeaways, because I think what you're doing is, as I said, virtuous, and I love the model. But what do you want people thinking about here in terms of when to engage you, when to start thinking about you guys, and how, just when it becomes relevant for you to jump in the game?
I'll start. I mean, I think earlier the better, right? That's always the message that, we engage with clients all the time. As Jeff will say, we'll always, he'll always take a phone call and kind of give you kind of his thoughts on current situation that you have or a planning opportunity. If you get that unsolicited offer, we're happy to step in as well. We love building relationships with other attorneys, tax accountants, people that we can work with in a collaborative that serve our client base, right? I think one of the things that really attracted us to Callan was that ultra high net worth client base, because the size and the complexity of the deals we were working on was increasing, right? And you really need a full team that can kind of address all the dimensions of wealth. So for us, the ability to, if they're looking for someone who, they have someone that's operating on the business side and helping them kind of advise on the business, the ability for us to step in on the personal side and kind of unite those two, I think that's huge. Instead of looking at your life in silos, because as a business owner, you can't look at your life in a silo. It's all one aspect. So I think, the opportunity for us to advise on that.
Oh, that's great. Jeff, what do you think?
Yeah, I would say that the thing that always sticks in my mind is what I call the perpetual 3 to 5 year cycle, where when you talk to most entrepreneurs or business owners, you ask them, well, what's your plan? And they'll say something to the effect of, well, I'm going to sell or give it to my kids in the next 3 to 5 years. And if you talk to them in 3 to 5 years, they're going to say, well, I'm going to do something the next 3 to 5 years. Or if you try to pin them down on that, you say, okay, you're going to do something the next 3 to 5 years. What are you doing today to be prepared for that 3-year window, right? And the answer is almost nothing. So we really try to get people focused on if that is really your timeline, or to Lisa's point earlier, 50% of deals start with an unsolicited offer. let's get you ready for that, right? It doesn't really cost you that much to be prepared for that unsolicited offer. Get the business ready, right? Pre-due diligence process. Get yourself ready. Start psychologically being prepped for what that might look like. Once you start that first step of the 10,000-mile journey, so to speak, it gets a lot easier to start thinking through tax strategy and being prepped. The business ready, you're ready, your tax strategy is ready. So if somebody does pop out with the crazy big offer, you can actually action on it. You don't have to. You're just ready for it. And that's really the key here, is you're just kind of sort of ready for it. Or if your goal really is to transition it to the next generation or your management team, you're prepping them to take over. Because I would say the worst thing we see is when someone says, you know what, I'm not going to sell. That's cool. We get it. You don't want to sell. Totally understand. I'm going to let my kids, my management team, whatever, take over. That's great. But they do absolutely nothing to get them ready. And then the owner passes on or gets sick or disabled or something like that. And then it's just a disaster, right? No one's ready to do anything. That's the worst outcome, I think. So it's always just, it's another version of the prep, right? It's just another version of being ready. It's another version of thinking things through. What would things look like if I take myself out of the picture? What would things look like if somebody popped up and gave me an offer? That's what it all comes down to. It's just always being in that mindset. And by the way, business owners typically think this way because they're successful business owners. They're always thinking 5 moves down the chessboard when it comes to growth, acquisition, market share, right? All these things that are geared towards sales and growth. The one thing they're not typically doing that on is this, the exit strategy, the transition transaction piece. Our job is to just help them fill in that gap. And if they're not going to work with us, that's fine. Find someone else that does this type of work that can help you do it, because that's really the key here, finding a good advisor that can help navigate you through it. And if they're not having this kind of conversation, pick up the phone and find somebody you can. Right? That's really the key.
That's a great message and a great way to end the conversation. I mean, it's especially now with all the uncertainty with the presidential election and all the things that are happening around us, uncertainty in ways maybe we've not seen before, actually, with some real potential, instability issues that could be coming down the road over the next year. I've been saying a lot lately that this uncertainty is a driving light and a call to action. So it isn't just about a business plan succession for a business owner, but I think it applies to all kinds of planning. If you're uncertain and worried and anxious, then do something about it. And that's another way of saying, use this uncertainty as a call to action. But what you have done and what you have built is amazing and very impressive. I have tremendous respect for the space that you're in, because I think there's such a need for it. I applaud you, not that you need my applause, but I applaud you for going to Callan. I mean, clearly, I refer to Bridgeford as a rocket ship too, but watching Callan ascend has really been amazing, and the potential for both of our companies to do amazing work together for families across the country and around the world is just, I think, limitless. So, Lisa and Jeff, thank you for taking the time to talk with us. For the audience, of course, contact information will be there next to the play button. So if you have any questions where you are thinking 3 to 5, or you just want to prep just in case a big offer pops out, like Jeff says, please call them. Clearly, they're expert in their field. They are experts in their field and thought leaders. And I'm just thrilled that we have this friendship and professional partnership going. So anything else you'd like to add before we let you go?
No, David, this was great. Thanks. And we have tremendous respect and look forward to working with you in South Dakota more frequently.
Excellent. Appreciate it. Jeff?
Yeah. Thanks, David. Really appreciate the time. Really appreciate you having us on.
Excellent. Talk to you guys soon.
Take care.
Be well.
Thanks again for listening to Bridgeford Trust Company's Delivering Direction and Control podcast series. Be sure to subscribe to our podcast to keep posted on when new episodes are added. And for more information, you can visit us online at bridgefordtrust.com.